ACG's Middle Market Growth Podcast. I'm your host, Carolyn Vallejo. Consumer sentiment is shaky, and recent surveys of middle market dealmakers consistently reflect low expectations for M&A activity in the retail sector this year. But a closer look at this picture might reveal a more nuanced and promising outlook for the industry. PwC's Mike Ross joins us to offer some clarity into the retail M&A landscape. Welcome, Mike.
Hi, Carolyn. Thanks so much for having me.
Thank you for being here. And of course, we would first love to get to know you a little bit better. So tell us about your role at PwC.
Sure. So I'm a partner at PwC and I lead our consumer markets deals practice. So that includes consumer products, retail, wholesale, hospitality, and adjacent areas like travel, transportation, and logistics. I've been at PwC for nearly 25 years and have spent a significant amount of time working with both corporate and private equity clients on the sell side and the buy side, everything from smaller tuck-ins to larger global transformative deals. And so I would say here, deal making in the consumer space is as challenging as I've ever seen it since I've been at the firm here. But those challenges are also where opportunity tends to emerge. So we spend a lot of time analyzing consumer behavior because it's foundational to creating value in today's environment. And I'm really just glad to be here today to share some of those insights.
Awesome. Well, we're so glad you're here as well. You're definitely a great person to speak with about this topic. But before we jump in, we like to ask our guests, if you could learn any new skill in 2026, what would it be and why?
Maybe cloud coding, not because it's trendy, but because actually my first career in the 90s was actually as an e-commerce developer. Think of those first generation e-commerce sites. So I think it's relevant and also it could be a fun way to kind of get back to my roots.
Well, let's dive into it. Retail M&A, you mentioned this is one of the most challenging times that you have seen. And, as I mentioned in our introduction, surveys from middle market dealmakers, including surveys conducted by ACG, have found that retail tends to be ranked as the least likely to see increased M&A activity in 2026. Yet there have been some promising and some high profile deals even already this year. So can you tell me about what you're seeing and what your outlook is for consumer M&A and retail M&A specifically?
Sure. Well, I'm not surprised by the survey. Retail certainly is tough right now, but we're seeing a steady flow of deal activity, including some of the larger transactions, as you mentioned. I think it's important to recognize that like retail isn't just one market. It's really a collection of different markets. So grocery, value, apparel, specialty, luxury, they're all operating under very different consumer dynamics. Understanding those differences is critical when you're evaluating M&A opportunities. Now, what we're seeing in the consumer behavior space here is a real divergence. Even as high income household and holiday spending grew year on year, some of that growth shifted from value retailers towards the value retailers, I should say here, rather than the mid-tier players. I mean, that reflects, I think, what we're seeing more broadly in the economy. So while these higher income households account for a growing share of overall spending, the majority of the consumer segments remain price conscious. That means that the value formats are gaining momentum, with volumes growing about 16% year on year, while mid-tier food, mass, drug retailers collectively lost more than 2% of wallet share. Consumers are optimizing the spending on essentials to protect spending on experiences. And in other words, they're trading down on basics so that they continue to spend on dining, travel, and what we often call meaningful moments. And so the result then, is this clear barbell effect in retail. Value formats and differentiated brands are winning while the middle continues to get squeezed. And so, what does that mean for deal activity? Investors are being very selective. I think we're likely to see deal activity that's going to be aligned with those consumer shifts. Differentiated brands that are tied to experiences or strong loyalty, and formats that are, I would say, relentlessly focused on value. The mid-tier retailers without that clear value proposition, those are going to be the ones that I think are going to see less interest.
Yeah, I want to talk a little bit more about which segments or pockets of retail offer that M&A activity. We've seen some deals in, for example, the fashion space and even the luxury space as of late. Is that indicative of that kind of divergence, that barbell effect that you just mentioned?
I mean, like, I think it's true. We've seen a number of deals in fashion and luxury over the past year, but many of those involve larger global players, right? We may continue to see activity there, but again, buyers are being extremely selective in this space. Where I see the potential for more, I'll call it mid-market action, is in a few different subsegments. So first of all, grocery. Grocery remains highly fragmented with many regional markets, and scale matters more than ever. Whether that's improving purchasing power, optimizing supply chains, or investing in tech and automation to protect margins. There's a meaningful population of independent and family-run grocers who may be evaluating their option these days. Some may have expanded store footprints over time, but underinvested in tech, and now they're at a disadvantage. Others may be approaching retirement without clear succession plans. These things could drive mid-market consolidation to gain scale without triggering the same sort of antitrust scrutiny we might see with larger deals. In off-price and value formats, consumers across income levels, they're becoming more value conscious. These retailers are gaining share because they offer those trusted pricing models and disciplined inventory management. There's an interesting point that was raised at another consumer conference a couple of weeks ago, and that was that high-income consumers are often the most likely to buy on promotion, which I thought was interesting. When you think about it, they have the spending capacity, the storage at home, and they enjoy finding a deal. I think, that shifts how we think about the target demographic, for these off-price and value formats, maybe differently than we have in the past. And then lastly, there's what I'll call specialty, experiential, and service-related retail. Investors tend to favor brands that build deep customer connections. These retailers, they create community and identity around a brand, through unique products, education events, or immersive in-store experiences. This drives stronger loyalty and often a more predictable purchasing behavior. These experiential formats, they also tend to drive repeat visits. So when you're evaluating a deal, investors are looking for in-store activation and engagement, whether that's, beauty consultations, fitness assessments, wellness treatments, or community events. These turn stores into destinations rather than simple transaction points. This increases the traffic, cross-selling, and revenue visibility. Consumers feel like they're part of the brand's DNA, in these environments, and that dynamic is particularly relevant for Gen Z. So, while we may continue to see activity in fashion and luxury, we're watching grocery value and specialty formats very closely.
ACG Access is officially open for DealMax 2026. Start scheduling your one-on-one meetings now and lock in time with the private equity firms, investment bankers, and deal makers driving middle market M&A. Don't wait, secure your spot today at dealmax.org. And in terms of deal structures, what are we seeing here? And I'm curious how maybe these deal structures are reflective of what's kind of happening on the broader macroeconomic level amid these shifting consumer habits and shifting generational habits as well.
Well, broadly across sectors, we're seeing an uptick in deal value, even though overall the volume has remained, I would say, relatively flat. And this is consistent with what we're seeing in consumer markets, by the way, too. We're seeing larger transactions, which often happens at the beginning of an M&A cycle as deal makers pursue first mover advantages. Now, will that translate into a pickup in mid-market activity? It's probably still a bit too early to tell. In terms of transaction types, though, some of the largest deals in 2025 have been take privates. Take private and turnaround situations continue to drive larger retail deals, as private equity looks to restructure businesses outside the pressure of public markets. In fact, we actually looked at a few, I'll call them creative situations last year. They were pretty compelling, but ultimately a bit too challenging to execute in the environment today. I think we could also see more carve-outs. These would be resulting from portfolio reviews, particularly in fashion and apparel, but also in CPG, where many of the global players are looking to sell non-core assets. And by the way, I know we're mainly talking about retail today, but CPG, is where I think M&A is going to get interesting in the next couple of years. That whole sector is really going through a generational reckoning that it too, just going through that reckoning, can have some pretty interesting knock-on effects to the whole dynamic between, CPGs and retailers. But getting back to retail and mid-market though, I think there's still a pretty healthy skepticism around retail because the trends are shifting so quickly, like you said. When you look at shareholder returns in this sector over the past year, you see pretty meaningful volatility. In other words, companies flipping from positive to negative and back again. The leaders are the ones, though, who continue to deliver the strong returns, really reinforcing the point that investors continue to reward scale, resilient demand, and strong execution. And so as a result, deal makers are focused on identifying businesses with those durable trends, controllable profit levers, and differentiated brands that can really protect pricing. Even subscription models, I think this is interesting. These were once viewed as, by investors as inherently pretty resilient. Even those are being scrutinized more closely as consumers, have accumulated so many over the years and are now starting to reevaluate those recurring commitments. From a diligence standpoint, what we see here too, I mean, processes are running longer. Buyers and sellers are deploying increasingly sophisticated data stacks, to test value creation hypotheses and identify behavioral trends that can create an edge. The last thing I think that's interesting here is IPOs. There's still a backlog of PE-owned portfolio companies looking for exits. A few months ago, I probably would have expected a more active IPO market this year, but so far the broader global market volatility, I would say has really introduced some hesitation. Not
Mhm.
just in consumer. So I think we're likely to continue to see dual track processes that preserve that flexibility between a sale and a public offering.
I did want to ask one question about valuations. I know you mentioned that we are seeing, some larger transactions. It's too early to tell right now whether that will kind of trickle down to more deal volume in the middle market. One thing I'm curious about, though, is that there has been this kind of buyer-seller price gap that's been a challenge across sectors, quite frankly, for the last few years. And I'm wondering if you've seen whether deal makers are finding themselves on the same page within the retail sector for the deals that are getting done in the middle market, or is it too early to tell?
I don't know that I wouldn't say it's too early to tell. I think we're continuing to see, a lot of the skepticism I talked about, and how that plays out in practice here is, often longer processes. A lot of times when I'm talking to clients here on the sell side, and and they're maybe going through a divestiture, we spend a lot of time talking about like what the value creation story can be. And I would say it goes beyond maybe what I would call like traditional banker equity stories, right? It really gets into what are the levers, what's the underlying data that supports this value creation story for the next owner. I think that process tends to be what elongates the timeline, but it's often the most important part in helping bridge this valuation gap that you see between sellers and buyers.
PwC released a report recently on the consumer and retail space. And in that report, it was noted that there is this convergence with retail and tech, among other verticals. And I think you've kind of made the point in our conversation today that retail does not exist in a vacuum. It is a collection of different markets. You mentioned CPG, food and beverage, like the grocery space, for example. But I'm really interested in this convergence between retail and tech that the report noted. Can you tell me a little bit about that, what that looks like, and how that might influence M&A opportunity in the space?
Yeah, that's a great question, and it's absolutely true. The lines are blurring more than ever across, not just retail and tech, but pharma from a consumer wellness perspective, and even financial services. Retail and tech, I think you can't look at them any longer as separate sectors. Tech is increasingly becoming, what I'll say, the operating model of retail. On the front end of it, AI is shaping discovery, personalization, purchasing decisions. On the back end, it improves, planning, supply chain optimization, procurement, and customer service. What's different now is that I wouldn't say tech is just an add-on like maybe you thought about it in the past. It's embedded in the operating model. It's interesting, during this past holiday season, what our research told us was the generative AI referral traffic to major retailers increased roughly 700% year over year.
Wow.
Yeah, I mean, younger consumers, I mean, they're the ones that are accelerating this shift, right? So if you think about, Gen Z spends, I find this stat staggering here, close to 90% of their free time online, and their behavior is the behavior that increasingly feeds the algorithms that influence what others see next. And Gen Alpha is going to push that even further, right? I mean, they're the first generation here that's basically growing up, where the same device is both an entertainment platform and a storefront. And this convergence then creates different aspects to M&A opportunities around capabilities. Think personalization engines, retail media, data infrastructure, digital engagement. It's not just about brands or store footprints anymore. From a data perspective, again, something interesting I had heard recently, we're seeing companies here, CPG companies, in fact, here that are collaborating on what's called clean rooms to share data, in a compliant way with retailers to better understand shopper behavior and trade efficiency. In the mid-market, a key question is whether, the companies have that data infrastructure and that analytical capability to really anticipate demand and optimize, their assortments and their pricing. AI may lower certain barriers, in the mid-market here, but high quality data remains a competitive advantage. I mentioned financial services. This is pretty interesting. We had our financial services leader on our Consumer Markets Hot Topics webcast recently. What we talked about here was as agents are increasingly influencing discovery and purchasing, the payment often, now becomes embedded earlier in the journey. This could fundamentally reshape, what a lot of financial institutions think about the top of wallet. Payment decisions, are increasingly, they can be increasingly optimized by these algorithms, right? So based on price, approval likelihood, rewards, speed, or sustainability, rather than just pure brand loyalty. That can create new competitive dynamics and partnership models. And so, as commerce becomes more agent enabled, brands and retailers, may look to own or partner around payments, lending, loyalty, and data to remain relevant throughout the purchase journey. And so I think the boundaries between consumer, retail, tech, financial services are clearly burning.
Absolutely. And it seems like some value added opportunities here for deal makers as well to integrate a lot of these new capabilities, new tech, new functions into existing platforms too. So that's quite interesting. All right, Mike. Well, you've just shared so much analysis, insight into the retail sector. There's a lot changing here, and it sounds like there is going to be there is already quite some opportunity for middle market deal makers, both strategic and private equity. But maybe you can give us a final takeaway. What is your overall sentiment, your overall outlook for retail M&A through the rest of the year?
So if I had to boil this down to maybe three things that are influencing the retail M&A, I'd say this. So number one, the consumer environment is more complex than ever. We talked about that, with consumers splitting between premium and value, focusing on benefits and outcomes rather than traditional categories. The biggest mistake that can be made right now is to underwrite a deal based on the average consumer. I'm using quotes here because I'm not even sure what that looks like. Modern analytics are essential to generating underwritable insights today. Number two, scale still matters. I hit this point a few times. I think, this suggests potential consolidation opportunities, particularly in fragmented subsegments. And then, lastly, number three here, retail isn't just retail anymore. Deal makers need to be fluent in how tech, life sciences, financial services, they're all converging to reshape the consumer landscape. And that convergence has significant implications for M&A strategy.
All right. Well, Mike Ross from PwC, thank you so much for joining the podcast. We really appreciate it.
Thanks for having me.
Thank you for listening to this episode of Middle Market Growth Conversations. If you haven't yet, please subscribe to the podcast on Apple Podcasts, Spotify, or wherever you listen to podcasts. This podcast is produced by the Association for Corporate Growth. Learn more about us and discover new opportunities to network with middle market deal makers at acg.org. For more thought leadership from deal makers, business leaders, and other experts, visit middlemarketgrowth.org. If you like what you've heard today, please rate and review the podcast. And finally, if there's a topic or guest you'd like to hear on the podcast, or if you have any other feedback you'd like to share, send a note to us at tips@acg.org. Thanks again for listening.